Have you ever felt like you're just one step behind the market, like you see a huge move happen but only after you've been stopped out? Well, it's probably not random. There's a playbook that the big institutions use, and they leave footprints all over the charts. So today, we're going to decode that playbook. Hey everyone, welcome to AI Explains ICT. In this video, we are diving deep into the core content from Month 3, Episode 3. We're going to focus on one of the most powerful concepts you can learn from ICT, and that is institutional sponsorship. Seriously, this is one of those ideas that can totally change how you see the market. So, are you tired of jumping into a trade just to watch the market slam against you? You know that feeling, right? Getting stopped out just before the real move finally takes off? Yeah, that happens for a reason. There's a whole different game being played, and we're about to decode the playbook the big banks use so you can start trading with them, not against them.
The whole idea we're talking about here is called institutional sponsorship. And really it's simple. It's the evidence left behind when large institutions, we're talking banks, fund a major price move. Think of it like a footprint in the snow. It's proof that they were there. And if you can learn to spot these footprints, you can start identifying some seriously high probability setups.
Okay, so how do we actually find these footprints? It's not about guessing, not at all. It's about following a clear checklist. So let's break down the 3 absolute keys that tell you a move has some serious institutional muscle behind it.
All right, here are the 3 things you need for a solid long setup. First, you've got to see a big aggressive price move on a higher time frame. We call that displacement. Second, right before that big move, you need to see a clear run on liquidity, usually price dipping below an old low. And third, there has to be a logical target, a reason for the move waiting up above.
Theory is great and all, but let's see what this actually looks like on a chart. We're going to walk through a case study on a higher time frame, piece by piece, so you can see this checklist in action. This is where it all clicks. Okay, so take a look at this daily chart. The whole process usually kicks off with what looks like a trap. See how prices push down below that important old low. So why does that happen? It's simple, really. That's where tons of retail traders have their sell stops. The big institutions see that as a giant pool of liquidity they can use to start buying up their positions. But here's the real secret. While they're busy buying down there, their eyes are on a prize much, much higher up. This chart shows their true objective. Up there, above those old highs and inside that liquidity void, that's where the buy-side liquidity is. That's where all the short sellers have their buy stops. For the institutions, that's the perfect spot to unload the long positions they just bought. And this is the footprint. This sharp, explosive, almost violent move to the upside, this is what ICT calls higher timeframe price displacement. This is not your average retail buying. A chart doesn't move this fast, this aggressively, without some serious sponsorship from the big banks. It's their signature, clear as day.
And this brings us to a really important quote from ICT. If you're on the right side of the marketplace, the market's going to move dynamically, immediately, soon as you get in. Think about that. If your trade is just sitting there, going nowhere, it probably doesn't have that institutional backing. A real sponsored move feels different. It's immediate, it's powerful.
So after that huge move up, what happens when price pulls back a bit? Well, institutions are going to protect their entry points. Notice how price comes back down to where that explosive move started. Specifically, that last down candle before the huge rally, that's a bullish order block, and you better believe they're going to defend that level, buying more to push price up for the next leg higher.
So, we've seen the big picture. Now how do we turn that into an actual trade we can take? For that, we've got to zoom in. We need to go down to the lower time frames to find the really precise footprints that give us our entry signal.
First things first, you have to completely flip your mindset. The typical retail trader looks at an old high and thinks, oh, that's resistance, I should sell. But the institutional view, it's the complete opposite. They see that same high and think, perfect, a giant pool of buy stops. That's our target. You have to start thinking like they do.
All right, now for a really specific tactic from ICT, and this one is powerful, the midnight open rule. On days where you expect the market to go up, pay close attention to the New York midnight opening price. Very often, the big players will push the price below that level first to grab liquidity and buy up their positions at a discount, right before the real move of the day begins. And this chart just shows it perfectly. See all those blue lines? Each one is the midnight open for that day. And look at the pattern. Day after day in this uptrend, what happens? Price dips below the open, finds support, and then rallies hard. It's a repeating pattern, a fractal, that gives you a super consistent model for an entry.
And there's another key entry concept. It's called recapitalization.
Basically, institutions will bring price back to old bullish order blocks, those key down candles before a big move up, that were formed in previous sessions, like London or New York. They revisit these levels to buy again, adding more fuel to the fire to continue the move higher.
Okay, let's pull all this together. Let's create a final blueprint for you. These are the hallmarks, the unmistakable signs you should be looking for that tell you a trade has real institutional sponsorship behind it. So let's review. It starts with a clear run-on liquidity below an old low. Then you need that aggressive, powerful price displacement in the other direction. You need a clear target above the market, that buy-side liquidity. Then you want to see price come back and respect those old bullish order blocks. And finally, when you get in, the reaction needs to be fast and dynamic. That's the whole signature.
So the question I'll leave you with is this. Now that you know what you're looking for, can you go to your own charts and start spotting these footprints? Can you see where the smart money is tipping its hand?
Hey, if this breakdown helped you connect some dots, do us a huge favor and hit that like button and subscribe to the channel for more content like this. And seriously, if you have any questions, drop them in the comments. A real human will get back to you.
Until next time, stay safe and happy trading.